In this video, we will be talking about a few basic yet important financial ratios that are necessary to look out for when conducting the fundamental analysis of a stock. These financial indicators will help you in analyzing the company. All the financial indicators that are going to be talked about should not be analyzed like an absolute value. They should be analyzed by comparing them with the other companies in the same industry. Firstly, we will be talking about the price to earnings ratio. It is calculated by dividing the current price of the share by the earnings per share. Earnings per share is calculated by dividing the total profit of the company by the total number of shares of the company. If there is a loss making company, then the PE ratio for that company would be negative, as the earnings per share would become negative. So in case of loss making companies, analyzing the PE ratio does not make much sense. PE ratio basically tells us for each rupee that the company earns as profit, how much money are we investing in the company. The PE ratio can be used to check if a company is overvalued or undervalued. The PE ratio of the company can be compared with the historical PE ratio of the company, meaning the PE ratio of the company in the past months and years. The current PE ratio can also be compared with the industry PE ratio, meaning the overall PE ratio of all the companies in the same industry. If the current PE ratio is comparatively very less, then either the stock is undervalued or the market expects the earnings of the company to grow at a slow rate in the future. A stock with a low PE ratio can have more potential of growing by increasing its earnings in the future. As the earnings rise, mostly the price of the stocks also rise. On the other hand, if the current PE ratio of the stock is comparatively very high, then either the stock is overvalued or the market expects the earnings of the company to grow at a faster rate in the future, due to which the prices of the stocks are currently high. We should not compare the PE ratio of stocks of companies in different industries, because the average PE ratio of different industries vary a lot. Next, we will be talking about the price to book ratio. It is calculated by dividing the current price of the stock by the book value per share of the stock. The book value per share of a stock is calculated by dividing the shareholders' equity of the company with the number of shares of the company. Shareholders' equity is the difference between the total assets and total liabilities of the company. It indicates how much money the owners of the company have employed in the business. The PB ratio is also a valuation ratio. It helps us determine whether a stock is undervalued or overvalued. PB ratio, when compared to the PB ratio of the other companies in the same industry, would help us determine the same. A low PB ratio means the stock is undervalued, and a high PB ratio means that the stock is overvalued. A comparison of the PB ratio of two stocks from different industries should not be done. Now we will be understanding about the debt to equity ratio. It is calculated by dividing the total debt of a company with the shareholders' equity of the company. Debt is basically the loan taken by a company. The debt to equity ratio gives an idea about the debt that a company has taken in comparison to their own capital employed. A low debt to equity ratio is ideal, which means that the company is less dependent on leverages and is able to operate by its own finances. However, the debt to equity ratio differs across different industries. Like the banking industry, almost all the banks have a debt to equity ratio over 4, 5 or 6. So the debt to equity ratio of a company should be compared with the other companies in the same industry. Next, we will be talking about ROE and ROCE. ROE is the return on equity. It is calculated by dividing the net income of the company by the shareholders' equity of the company. The higher the ROE, it is usually said the better it is, but in that case it is even possible that the company's debt is very high. This is because in the formula of ROE, in the denominator, there is the shareholders' equity, and as talked about earlier, that the shareholders' equity is calculated by subtracting the company's debt from the company's asset. So if the debt is very high, then the value of the denominator would be low, which would result in the rise of the ROE value, which could be misleading for us. Hence, ROE should always be looked at along with the ROCE. ROCE is the return on capital employed. It is calculated by dividing the company's profit before interest and taxes by the total capital employed by the company. These ratios help us understand the company's profitability in terms of the capital that has been invested in the business. Hence, the higher the values of these ratios, it means that the company is able to generate more profit on the capital in terms of percentage. But again, ROE and ROCE of companies should be compared with the other companies in the same industry. Following that, we will be talking about the current ratio. Current ratio is the ratio of the current assets to the current liabilities. It is calculated by dividing the current assets by the current liabilities of the company. Current assets is the total value of the assets that the company would be able to liquidate in the next 1 year, which means convert into cash in the next 1 year. Current liabilities, on the other hand, is the total amount of liabilities that are to be paid in the next 1 year. The current ratio gives us an idea about the liquidity position of a company and how well equipped they are with the financial resources to pay off their current liabilities by their current assets. Usually, a current ratio safely higher than 1 is ideal, which means that the company can pay off their current liabilities safely. However, there are industries which have a low average of current ratio as they have to work with high debt. So the current ratio of companies should be compared with the current ratio of the other companies in the same industry. Lastly, we will be talking about the dividend yield. To understand dividend yield, we will first have to understand what dividends are. So there are basically two ways of earning money by investing in stocks. Firstly, as we all know, is through growth in the price of a stock, and secondly is through dividends. A dividend given per share is any amount of money given by the company to its shareholders. Companies can give dividends to their shareholders. Not all companies give dividends, but many of them do. A company which gives dividends usually signifies that the company has a stable business, as the total dividend that the company gives to its shareholders is a part of the money earned as profit by the company. But it does not necessarily mean that a company which does not give dividends has an unstable business. Like Google, it is a very stable business. It has a very high market capitalization, overall a very good stock, but it does not offer any dividends, as the profits earned by the businesses is reinvested back into their business to generate more profits, which would eventually lead to a growth in the price of the stocks of Google. Dividend yield is calculated by dividing the annual dividend given per share by the current stock price. Thank you for watching this video. I hope that this video helped you get to know about the 6 basic financial indicators you must look out for while conducting fundamentals analysis of any stock. In the next video, we will be talking about how to conduct fundamental analysis of a stock.